So welcome everybody. Good morning, or if you're joining us from Europe or Asia Pacific, good evening, good afternoon. Always great to have everyone out today. We'll just wait a few minutes as more people come into the room. So you have a minute or two maybe to grab a coffee or a tea or a beer, or if you happen to be lucky enough to be watching this webinar on a beach, grab a mojito or a margarita maybe. It's always great to have everybody out to these things. As you can imagine, with a company like Ely Gold Royalties, there's a lot of moving parts. And the nice thing is that Trey and the team do these town hall webinars to keep everybody in the loop on all the moving pieces that go on at a royalty company. So maybe if you could just, as long as you can hear me, maybe just say hello in the chat, throw in a comment, say good morning, good afternoon. Let us know that you can hear us. Let us know where you're from. It's always good to know, where everybody's coming from today. So just, if you can hear me, throw a comment in the chat. We can hear you well, something like that while we're waiting.
Kevin can hear us.
Yeah, Kevin can hear us. So we've got Gary from Las Vegas. Seth, good morning. Good morning, Angelina. Just wait a few more minutes, or maybe another minute here to let people come into the room. I still see the attendee list increasing. Good morning, Conce from San Antonio. Stefan from Switzerland. Hello, Paul. Good to see you. Jacques, good morning. Richard, Alfred, good to see you. Aloha from Michigan. James, nice to see you. Okay, so just, I know some of you may be veterans of these town halls, but as a refresher to everyone, if you look on your right-hand side of your screen, you should see 3 tabs. One of them is a chat function, and that's for you to chat with your fellow investors or listeners. If you want to ask a question, please remember to put it in the Q&A section. So as Trey is doing his presentation this morning, just you can throw your question in there anytime you want. And then once he's done filling everybody in on the updates at Ely Gold, we'll get to those questions. You can update those questions, you can upvote the questions. So if somebody asks a question that you think is really good, you can actually upvote it. And those are the questions that'll be answered first. And the other thing to note is this presentation will be available to you as a handout. So in the handout section, you'll be able to download this presentation. So I think that's we're probably good to go. So without further ado, joining us from the Lone Star State this morning, Trey Wasser, President, CEO, and Director at Ely Gold Royalties. Take it away, Trey.
Well, thanks, John, and thanks for filling in for Brandon this morning. You did a great job of opening us up here. And hello, everybody. Thanks for listening in. It looks like we've got a pretty good group here. I'm going to approach this a little bit differently today, because I think a lot's been going on in the market overall, and at the company. Our stock, which has been a great performer for the last year, has been going through a consolidation phase. So I wanted to spend a little bit of time on that, maybe give the audience a little lesson in technical analysis. But I want to have plenty of time for questions. We've seen since our last real webinar a big increase in the price of gold, and then a pullback now that's happened in the price of gold. So I want to maybe speak to that a little bit if there's some questions on that. So I want to leave plenty of time. So I'm going to kind of jump through the presentation very quickly. I'm hoping here that most of you have seen the presentation and before or heard the presentation. So with that, I'm going to of course, jump right through the forward-looking statements, but be assured I'll be making plenty of those as a junior royalty company. Which everybody knows, I think the Ely story still Nevada focused and gold focused. Although we've been adding some assets in Canada, most recently with this announcement this week of the Cote royalty. I wanted to speak to that a little bit, and I think I'll just open up with the Cote thing because I think it was a bit of a confusing transaction, a few moving parts to it. And so for everybody who wanted an explanation of the Cote press release, I'm going to make it very simple. Is IAMGOLD has a right of first refusal on this royalty. If they accept it, we are just going to get a break fee which we will reinvest into shares of Santana Gold and get a portion longer term of the bonus payments, 50% of the bonus payments. So it goes away. It's really not an issue. We add that to our stock portfolio, and it paid for our time here and the due diligence of looking at the royalty. If we do get the royalty, we're very excited about it. It covers some key ground around what will be Canada's newest and one of its largest gold mines. Cote will produce about 40,000 tons a day, about 500,000 ounces of gold a year. We have some key properties surrounding it. In fact, all the properties surrounding the main deposit there. And we will get that royalty and 100% of the bonus payments. The bonus payments come when a production decision is made on any of the claims, and that's $1.5 million, and another $1.5 million when it reaches commercial production. So basically, since the mine will be in commercial production, when they decide to mine on these claims, which we're pretty confident they will, could be 10 years away. But we'll get $3 million up front, so we'll get our money back and then have the royalty. So the numbers work out very well, no matter, even if we don't see this come into production for 10 or 15 years. But, we think it could be much sooner. Our claims have some of the higher grade ore surrounding in a couple of different deposits. There's one that was outlined of around 200,000 ounces just outside of the pit. And we think that when they get into production, they are going to need higher grade ore, and they're going to be looking for exploration and development on these claims to provide some higher grade ore for what is going to be a fairly low grade mine to start with, and we think they may have trouble with the grade as they go along. So, any other question on that? We can hold them to the end, but I'll then keep going. But I wanted to touch on that first because I know that news might have been a little confusing for shareholders and analysts this week. We, of course, still, even with the pullback in the stock, have still well outperformed all of our royalty peers. And, the reason is that the acquisitions we've made this year to date have our net asset value has actually gone up much faster than our royalty price. So even today, with the pullback in our stock and the activity in some of our peers, some new guys, new company on the block, the Nomad Royalty, and of course the one we like to compare ourselves to the most is Metalla Royalty, trading at 1.8 almost times NAV in the case of Nomad, and 2.3 times NAV for Metalla. And we are down, at today's price, probably just about 0.9 times NAV. So undervalued again to our peers, and significantly undervalued compared to the major companies, which have moved to well over 3 and getting close to 4 times net asset value. So a good slide here that kind of shows the universe, and you know, and this you know, this slide we show because even though we have had the good performance, I've updated this slide with some with the insets for Franco and Royal, showing the long-term charts. And of course, the bigger charts are just the first 4 years of performance. And you can see that whether you look at the first 4 years, the first year for us, or, you know, and our charts certainly starting to look very much like the long-term charts for these companies. So we think we are building a long-term royalty company, have a long-term conservative strategy, and you know, and our chart's starting to reflect that. Now, the you know, the model for us, again, always being stressing the fact that we are building a portfolio from the ground up with our staking and property acquisition and sales, and thereby generating royalties, and then continuing to buy third-party royalties. We also recently purchased 3 royalties from the old prospector Ken Snyder, and we continue to find these opportunities for royalties from some of the old-time prospectors based on Jerry and Bill and my own relationship. So not so much the competitive situations. Now going forward, we are starting to look at some activities for financing royalties in some packages, financing packages for some mine expansions. The you know, again, I want to just I think everybody knows here. You pretty much we're still well cashed up with over 11 million, 12 million in cash and restricted stock. We have not drawn on our line of credit, which we paid down after the first offering. You know, I want to point out something about that again, kind of focusing on this stock performance for everybody, and this is what I was talking about. Maybe a little bit of a technical analysis here. You know, we have seen the stock consolidating. Stocks and commodities consolidate in 2 ways, both in price and time. So what we have done over the last couple months is consolidate, certainly with a downward direction, but you know, we've held up very well right at with the pullback here at on the weekly basis at you know, around those key moving averages. In the case of a weekly chart, you know, that's a 10 and 26 week chart. So you that 6 months, and you go back to this other chart too. You can see, and this chart could be updated a little bit, because we did this last week. We dropped down to about $1.05, $1.10 on one day. What happened last week in the stock is that we had the stock with the 4-month hold from our May private placement came free to trade last Monday. So that was the day you saw some selling pressure, kind of a capitulation, if you will, on the downside. The stock tested the 200-day moving average, which was the red line, and bounced off of that very nicely. So we never, you never like to see the stock going down. We prefer it when it's going up. But we think that the stock is actually acting very well. It has had a nice consolidation along with the price of gold, and so that we are set here for if we could close a couple more key acquisitions that we're working on, we think we are poised here for another move up. And you can see how that's happened in the chart, and that this sideways to downward consolidations is nothing new in the chart of our stock, but any growth stock. So Uh, one thing we talk about a lot, and again I think is important. We've gone over our business model before of generating and purchasing royalties. Very active, and we're seeing a tremendous demand for our properties, and have 5 or 6 property sale deals in the being papered up right now. Our stock continues to trade even in this consolidation on with improving liquidity and better volume. But again, we always like to point out that when you look at our portfolio, our key assets, compared to our peers, or just in general, we have what we call we always like to point out that path to production. Very important. It's one thing to have the asset, but to us, it's also very important is who owns that asset and who is going to um, develop the asset. Is it in the hands of a junior company that has never uh, uh, built a mine, never operated a mine, and maybe doesn't have the capital to build the mine? So it's going to take a corporate transaction to actually move that project forward, or is it top operators? And I think that's where our portfolio really stands out. So we've when we talk about those key assets, for us, 11 of them, I'll drill down on those in a minute on a different slide, but 3 are currently producing, 8 are expected to reach production by 2023. Our development assets, now these are defined on a as and this list has actually grown now. If we close the Cote thing, and when we get the Snyder thing completely closed, be about 25. These are projects that are at or near producing mines, and meaning that to become a producing royalty for us, these properties do not have to get big enough to warrant building a mine. The mine in most cases is already there, or it's part of an asset that is already big enough so that they're permitting or getting ready to build the mine. And that's a very important distinction in our development assets, and that's by definition that's what it takes in our portfolio to fall into a development asset. And we have at some mines like the Gold Resource Isabella Pearl, McEwen Mining's Gold Bar. We have several assets, within. We have 4 at Gold Resource and 4 at McEwen Mining, all that could become producing assets within that current mine infrastructure. Our exploration asset portfolio continues to grow. We have 12 that are currently drilled right now. The Blackrock project, the Tonopah, is getting a lot of attention with some great results, as is the Contact Gold with Green Springs, and VR Resources with what they call their Big 10. So, and we continue to stake. We've staked some new properties that are very interesting. We're looking at some property acquisitions that could be very, very interesting. So, that list of 100 property interests in Nevada and the Western United States and the few in Canada remains, a solid part, or that underpinning of our story is a lot of properties. I'm going to talk quickly about the key assets and drill through. At Isabella Pearl, we have a producing royalty. That mine came into production last year. It is a 0.75%. It's not that mine is gearing up as far as production. We do have all the expansion ground where they're drilling now. That's a higher royalty on that. That's 2.5%. So we expect them to expand that project over the next few years to include that other ground there. At Jarrett Canyon, they continue to improve things there. We'll do about 135,000 ounces this year. We have 2 royalties there, one on everything that goes through the mill. That's a per ton royalty, which if gold can hold above go up and hold above $2,000 an ounce, we get a nice increase on that royalty. And then, of course, the 0.5% NSR that is, we think, going to continue to grow. They have, they're only producing there at about 50% of capacity at the mill, and they have an exploration program that has uncovered some high grade pits that were not mined in the past because of a high strip ratio. But most importantly is at Jarrett Canyon is late last year they completed a new water treatment plant, very state of the art, and this is going to allow them to go in and start mining some of the deeper underwater ore that's under the water table. And they're going to start there by going back into some of the high grade stopes. They're mining about 8 grams per ton there now. In some cases, maybe a little higher, but they're going to have some access now on some of these old stopes that ran 1/4 to 1/2 ounce material. So we're very excited about Jarrett Canyon. Rawhide continues to mine on our claims there. This is a 15% net profit interest royalty. So they're still working through some of their development costs that they get to deduct before starting to make payments. And we've pretty much negotiated those with them and know where they are on that. And so that by the first of the year, that will start paying. We also, at these higher gold prices, we get paid $29 an ounce on everything put on the leach pad above 115,000 ounces. And we think at these higher gold prices, it's looking like they'll mine somewhere between 200, 250,000 ounces at Regent Hill. So we'll also, and we have not figured in that bonus payment there. The Phenylon Wallbridge property, we're kind of sticking our neck out a bit on this one. I can't really show the slides as well as I'd like to. The way this is set up, I can usually link to these slides, and it's not letting me do it here. But at Phenylon, they have applied for late last year a small miners permit. For people who know that asset, in late 2018, 2019, they did a bulk sample program, mined down to 6 levels, and most of the current underground exploration, almost all of it, is being done from that 6th level. And that includes development work on the main Gabbro zone. So they're drilling development holes that are 50 to 100 meters to define that zone, as opposed to what would have to be 400 to 500 meter holes from surface. Now, the main discovery zone there, the Tabasco and the Cayenne zone, where they've had these, they've built up, depending on the analyst, between 2 and 4 million ounces. That's down another 6 or 8 levels, and those are 800 meter holes to drill into that from surface. And they're getting to the point where they just about can't drill any deeper and define this resource deeper from surface. So they are, in our opinion, when they get this for this small miners permit, which we think they should get late this year, we think they'll start to tell a story about going in and doing exploration work, and they're not talking about production there now because they simply don't want the market to think that this is a 400 to 500 ton a day operation. But we think they will be forced to go ahead and mine down another 6 or 8 levels, put in another exploration drift out above the Tabasco zone, and I'm actually gonna flip to that slide so I can show that here. This is what I'm talking about on the slide. This is you can see I've inset the 6th level where they're doing the work on the development work on this main zone here, and where they also did a lot of this drilling into the into the Tabasco zone. This is the heart of this deposit as we know it right now, reflected in some of these incredible intercepts here. And so we think what they will be forced to do here to really define this zone and develop it and make a long-term mill decision that makes sense is they will mine down, put a drift in out over here to where they can drill this deposit with shorter holes for definition drilling, and also then have access to at depth here. And you can see how far out they're having to get. I mean, to drill much deeper here, they're going to pretty much have to start drilling from Ontario. So that's the story that, we're telling that story. With the Wallbridge is maybe not telling that story, so we'll see who's right. We don't think whether it happens right away here next year as we're thinking or kicks out isn't going to be a big factor to the value of that royalty longer term, because that is getting to be such a big deposit. At Lincoln Hill, we recently increased our interest there from 1% to 2%. This is right next to the new leach pad that they're building at Rochester. They had got that permit early this year. That's due to be done by 2023. And the Lincoln Hill ore, being a higher gold grade than the Rochester ore, is some of the first ore they want to get on the leach pad there. At Marigold for SSR Mining, these are two royalties we picked up this year. One of the royalties we picked up in the VEK transaction. It's on two deposits that are in the current mine plan to start production in 2022. At the Wren property, we were picked up the two royalties, one in the VEK transaction and one in the NPI. And again, I'm gonna go ahead and jump forward to that slide. I can't do it as slick as I'd like to, but the Wren deposit we're very excited about. I mean, this has the potential. If you look at this of course the Gold Strike complex, the biggest asset. This is the asset that you have to say pretty much built Franco-Nevada. They had royalties all through these claims and through here. 35 million ounces came out of the pit here, about 15 million ounces in the underground right up in here, all controlled by this blue post fault that runs right up through our Wren property. The Wren was this 2 million ounces here in the JB zone was outlined in a joint venture with Centerra and Barrick between 2005 and 2010. Barrick then bought this property in 2012, bought out the Centerra share, and it hasn't really seen any real work since. But when they did this drilling here on the JB zone, actually up here at the northwest in the 24 zone, it's called. That's where the discovery hole is. It's down here in this picture, 42.7 meters of 34.6 grams. So they stepped out to the southeast with these other holes, continued to develop that JB zone. It is, and even was back then, expensive drilling. It's about 3,000 feet deep. But they defined that zone and then got bought out of the JV. And they never really stepped out from this discovery hole in the other direction. So we're very excited. We think that they will. This is permitted for production, the JB zone, and they're down to about their last 1 million ounces in the underground at Gold Strike at the Banshee mine, and so we think they'll be drifting in to this deposit and mining that here, and we're looking for production to start maybe as late as 2022. There, we're kind of again making a call on that, but they've indicated that they're moving in that direction, and we'll be putting out a 43-101 on that project here probably in the next couple of weeks. So, very, very excited about Ren. I have a personal bet with Eric Sprott that more gold will come out of Ren than comes out of Phenylon, and it's clearly a bet I don't mind losing or winning. The last two assets in our key assets, Hog Ranch, owned by Rex Minerals out of Australia. They're currently permitting in the permitting process. They just put out a resource of about 2.2 million ounces. It's a past producing mine, very close to Reno, year-round accessible. Going to be a great project for us longer term. And then lastly, Gold Rock with Fiore Exploration. They just came out this spring with their PEA on that, looking for production in late 22, 23. So here you have our key assets, 11 assets. 9 are at producing mines. The mines don't have to be built for these projects. The mines are already there. 10 of them are with operators who are already mining in their districts. And of course, on that list are some of the best mining companies in the world these days. And the status on them as far as the production, this is according to, to their mine plans and their projections. And as I explained, with the exception of Phenylon, these are not our projections, but the companies and the mine plans. So that they will drive this revenue model that we have here. Of course, our property sales in the blue, they run pretty consistent at about $2 to $2.5 million a year. These are this slide is just showing current contracts for property sales, not projections. So we have that base revenue there that generally will about cover our G&A, so that most of our royalty revenue, as it starts to come in and build up, will go to EBITDA and be available. Hopefully next year we'll be looking at a dividend program. So I'm at the management you guys can look at on the goals. We've already achieved all of our goals for 2020. So we've basically internally just doubled them, and we're working now on doubling, on doing that. We did this in the first half, so we'll just do it again in the second half. Summing up just briefly here, in that junior space, it's a good space to be in for investors. In the early years, you tend to get that high beta in the royalty companies, junior royalty companies, and of course we're now with our consolidation and pullback in the stock price, and yet continuing to grow that net asset value, we're undervalued again to our peers. We've got that strong growth model that is from the bottom up with our royalty generation plan, and then that clear path to production that I just pointed out with those key assets. And the last thing, of course, is that gold price leverage. We do think gold prices are consolidating here, but that you're in a very bullish environment for gold. That as long as the Federal Reserve they're doing the two best things they could possibly do for gold, and this is the central banks all over the world. They are printing money and keeping their foot on the necks of interest rates. So the one thing that really does compete with gold is high interest rate bond rates, and as long as the Fed keeps printing money and at the same time keeping interest rates low, we think it's a very good environment for gold. And on top of that, we think that with the things that are happening in the economy now, you're starting to see shortages in certain commodities. You're starting to see shortages in the housing market and big increases there. Even auto sales, really putting pressure on and upward pressure on auto prices and on the raw materials there. So we do think we're going to see a period of inflation over the next especially the next 12 to 24 months. And the Fed has actually also, added more fuel to the fire as far as the bullish case for gold. And that is that, they have decided that while they have a target of 2%, they're no longer going to just use that as a static target. They're going to start to use an average. So in other words, given the fact that we've seen inflation below their, as they stated anyway, below their targets for the last several years, they now are going to be accommodative and allow inflation to go higher, but then simply use an average so that they can say that they're meeting their 2% inflation target. So another very bullish thing for gold is that inflationary environment. So with that, I'm going to wind it up and see if we have some questions. Maybe John can come back in, and I was good this time and didn't watch the Q&A while I usually watch it while while I'm talking, and it can be a bit distracting. But I like to see those questions as they come in.
Yeah, well, you're going to get bonus points for that from Joanne, I think, Trey. You're going to get a gold star for focusing on presentation. So thanks again, as always. Always an informative talk you give, and I hope everyone enjoyed the update. We've had quite a few questions come in. So just as a reminder, if you haven't submitted a question but you do have one, please use the Q&A tab on the right. You'll see something that says Q&A. If somebody else has already asked the question that you wanted to ask, you can always upvote that question. So without further ado, we'll get right into it. And Trey, the first question is from Cliff, and you've kind of already touched on it in your talk, but he's asking, are you contemplating either a reverse stock split and or a dividend in the near future, 1 to 2 years?
Dividend for sure in the next 1 to 2 years. We hope our goal is to institute that next year. And keep in mind, for a small company, a dividend program is expensive. And we have certain criteria that we will not, we won't vacillate around for a dividend program. One is we want it to that dividend to be meaningful to begin with. Doing a token, it's too expensive for us for the dividend program itself. It has to be done outside by an agent that writes all the checks and does everything and accounting for it if we have a reinvestment program. So we want it to be significant and balance against the cost. We also want it to come from solid, predictable royalty revenue. We don't want to get into a situation where we declare dividend and then have to suspend it like Medla has. And we certainly do not want to be financing the dividend. So it's definitely something that is expected more or less by the market from a royalty company, and so it certainly is. We think we can achieve that next year. Now, as far as the reverse split, look, nobody likes to hear that word reverse split, but the truth is if you're doing it from a position of strength and for the right reasons, most of the time you see a reverse split, it's because a company, their stock's gone down and they need a reverse split just to get above the minimum prices to raise money again. That certainly isn't the case with us. Now, why we would where a reverse split would make sense is to achieve a U.S. listing on the New York Stock Exchange. And we saw Medla do this last year. We believe today one of the reasons that they traded we traded at a discount to them is because they have that listing and the improved liquidity that comes with that. It's not just more shares trading, but it's who can buy the stock. The ability with that listing to get into ETFs and that type of thing, certainly longer term, something we would like to think about and or that we consider. And especially since I think that it's probably only a matter of time before you see a royalty ETF on the scene. So if we were to do a reverse split, we've got some other things we need to do first. We need to get our AIF and prospectus done up that would be required for that listing. So you'll see us doing some of those things just in the natural growth and the corporate growth. Like I said, if you did see us do a reverse split, it would be in conjunction with a listing transaction.
Okay, thanks, Trey, for that detailed answer, and I'm sure that answers Cliff's question. So the next one is from David. He's asking, how does the Nevada tax proposal affect you?
Well, the Nevada tax proposal would for royalty companies, it's up in the air right now. We pay the 5% tax on the royalty income. And that's done one of two ways. Either the company, in the case of the bigger companies like Barrick, Nevada Gold Mines, they'll deduct it and pay that royalty on the behalf of the royalty company. They'll pay that tax. Other smaller companies like Jarrett Canyon, they end up at the end of the year giving us the equivalent of, in the U.S., what we would call a 1099, that they just basically report to the tax authority in Nevada that we've received this income, and then the taxing authority checks to make sure we've paid our fair share on that. So on the gross profits tax and the net profits tax that's being proposed, I want keep in mind that this is just a proposal. It would have to go on the ballot at one point and be approved by the on the ballot by the constituents of Nevada. It's not something that they can push through because of the Mining Act of 1872 and Nevada state laws. They can't push that through without a vote. But it's still a little unclear how it would affect us. And I think that the way it's being interpreted is that our tax would be more similar to it would be more dependent on the company and their net profit situation. So it could increase for us, but we don't think it would be substantial.
Okay, thanks, Trey. And David, I hope that answers your question. The next one, Renee's asking you to put your prognosticating hat on a bit here, Trey. He's asking, are we going to see a $2 stock price by the end of the year?
Joanne's saying no. Look, what I can say for sure is we've already seen a stock price of $2 this year. So we know it's possible. I mean, what we will need, I think, to see a $2 stock price is a resumption in the upward price of gold. And if I think you see that, I think you'll see the royalty companies, a lot of which have been consolidating in here, heading higher again. But as long as we keep our head down and keep doing our job and acquiring more royalties and adding to the portfolio, we have a lot of things going for us. We're undervalued to our peers right now. We've gone through the consolidation that I think a lot of the other junior mining companies maybe are just starting. Our stock price led when the price of gold went up in June, July, and it's reasonable to assume that the next move up in gold will be one of the leaders in that again.
Yeah, of course, stocks never just go straight up. All stocks have to consolidate at some point. And I know personally, I think when you see stocks consolidate, if you know what you own and you have confidence in it, you can view that as a buying opportunity. And in fact, a number of the people in this webinar have mentioned that. I know Kevin has mentioned he's been buying the dip, right? So if you like what you own, you can always view this as an opportunity. So not investment advice, of course. This is an interesting question. I don't think it's ever come up in any of the previous town halls. Michael is asking, would Ely ever think of merging with another royalty company?
Well, look, in the royalty space, I think a consolidation is going to be inevitable. When you have a situation where Wheaton Precious Metals is trading at 3.5 to 3.6 times net asset value, and Franco Nevada is trading at 3.75 times net asset value, and an Ely Gold with a portfolio that matches up very nicely and is trading at 0.95 times net asset value. You can see how they could acquire royalties companies underneath them at a discount and apply and those assets would then get applied at their multiple. So that type of is just a nature of the royalty business, is that size. Now, in the junior space, I mean, we've seen a lot of new junior companies come on the scene, and it is making the situation more competitive for royalties. And some of the companies, they have a kind of growth at any cost type of mentality. That's certainly not our mentality. But these new companies that are coming on the scene, you have managements there that they've just gone public. They're for the most part younger guys. They have they've got their game plan set out. So I think it'll be a while before you see too much consolidation, crosswise among the more junior companies. Certainly something that's possible, and I think us at Ely Gold, with us undervalued, we are certainly always feel like we have a target on our back, which is not necessarily a bad thing, because in an environment, and I think this will especially be true the next time we see gold run. Is that if the marketplace really starts to overpay for royalties, you probably won't see us. You won't see us in that game of overpaying. In an overpay for royalty environment, we are probably more likely to be the payee than the payor.
Okay. This is a trading related question. Trey Ursel is asking, or is mentioning, that Eric Sprott has mentioned naked shorting frequently. Watching the alternate market traders on Stockwatch, which has been confirmed very reliably to be the big banks in Canada front running and or manipulating with naked shorting and or dump and pump. Have you spoken to Eric Sprott on this about naked shorting or manipulation?
The answer is yes. It's and it's something that you would certainly like to see the Canadian stock exchanges get a handle on. It's one other reason why for the growth of the company to be able to move up into that New York Stock Exchange listing is very important. Makes it much harder for them to naked short your stock if you have that U.S. listing where they have two things. One, obviously, you with a naked short, for those of you who don't know exactly what it is, that means you can short the stock and not have to deliver the stock, borrow it from somewhere and deliver that stock in the 3 days for settlement. You can just leave a negative position on your books, and some of these Canadian banks and certainly the international banks, will allow this. The other thing you don't have on the Canadian exchanges is an uptick rule. On the New York Stock Exchange, you can't short a stock unless the last trade was an uptick. So in other words, you can keep shorting it and shorting it, shorting it, down, 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 and you don't have to have an actual buyer come in at any point when that short seller is selling the stock. So yes, we have talked about it. There's some initiatives going on that we've contributed to help curb that. The last report I saw, we had over 2 million shares short. I believe some of that was probably naked, but I can't say for sure. But we did have our stock coming off of free to trade, so we think a lot of the stock that was short was waiting for the delivery of the stock freeing up last week.
Okay. Renee just asked a question. It got upvoted really quickly, so I'm gonna ask. Rick Rule gives Ely Gold a 5, where 1 is the best, and says, "Nice small royalty shop, great local knowledge in Nevada, high G&A." Why is he saying high G&A?
Well, this past year, our G&A has spiked up, and it really was a matter of well, first of all, the COVID related. I mean, we ended up doing we had prepaid for a lot of shows, and it's difficult for a company when you're trying to do two things. You're trying to grow the company, but you're also trying to promote and get more shareholders involved, and that can be expensive when you go to the shows and do the traveling. The airlines don't say, "Oh, it's a smaller company; they should get a discount." And certainly, the shows don't do it. It's the same cost for everybody, whether you're Newmont Mining or Ely Gold. So we did some other promotional things this last year because we did feel we had a lot of momentum behind the stock and the company, and we really needed to get the word out about what we were doing, and that's been reflected in our G&A. I think going into next year now that we have a really good handle on doing these online things more by ourselves than with all these shows that and this would include Rick Rule's show, by the way, that doesn't come off very well. Didn't come off very well as a virtual show. Joanne's shushing me here, but I'm not afraid. I know. Anyway, our goal, one of our goals next year, in conjunction with wanting to do a royalty program, will be to really tighten our G&A again. And we can do that because, our G&A isn't expanded because we've got a big internal payroll. It's all outside consultants and promotional things that we did and tried to establish a good presence in the market for the name and to be able to tell the story. And because we do have a lot of moving parts with this story, we reached out there pretty hard this year, and we think we benefited. We think we increased shareholder value a lot more than we did the G&A. And I also might point out that Rick was in this stock very early and was a seller at 40 cents. So,
and we really concentrated on areas where we knew royalty companies would go very well, like Europe. So 18 months ago, I said to Trey, we need to go out and really focus on European investors. And, the proof is in the pudding. When we do these webinars, we have anywhere from 70 to 100, 150 people tuning in. When we first started doing these webinars, we were lucky to get 15 people. So, a lot of it is just building awareness, building a profile for the company. But Trey is right. This year, we're going to scale back. We know what works for us. We know what doesn't work for us. And we're going to build our budget and our program based on what we've done over the past 18 months.
I'll add one other thing too, and I don't know if when Rick looks at the financials, but we do, like a lot of junior royalty companies, we do use our stock quite a bit for incentive especially for these old prospectors to sell us their royalties. So, in the case of and that's something that, because of the volatility, and of course our volatility has been mostly up, is that when we issue warrants now on our most recent financials, which we would have been Q2 of this year, the auditors made us use a price of 50 cents on the dollar as a non-cash charge for every warrant we issued. So when we use those warrants to incentivize people to sell us their warrants, those go on. It's a non-cash charge, but a charge on the balance sheet nonetheless. And something else that when you look at just the bottom line, it looks like a lot of G&A there.
Okay. Appreciate those details answers, Trey and Joanne. Thanks for adding some color there as well. Next question's from Alfred. Where can we find the warrant exercise schedule? Are any occurring in the next 6 months?
The warrant schedule, as far as exercise dates, I believe is on the website. We have it broken down. I don't know that the exact dates are on there. It's something we can add if somebody wants. You can certainly find them in the financials, and I can tell you that as far as the warrants, most of them that would be coming due. And if you look at our corporate slide, 158 million shares outstanding, 198 fully diluted. Every warrant that we have is in the money. Most recently we issued the 20 million at $1 when we did that financing in May. Now those warrants don't expire for 2 years from May, but we do have an accelerator on them if their stock trades above $1.60. So, while it may be important for somebody to want to look at all the exercising, and most of the other warrants are small pieces, except the ones that Eric has. And I think that in the case of most of the warrants, that warrant that Eric has for sure, and the other ones, you can just assume they're all going to get exercised. Whether that means people are going to exercise and sell their shares, certainly I think we've seen some of that with this recent financing, where people sold their 80-cent stock and kept their dollar warrants. But that's just a function of the negative side of financing anytime you have to do it.
Okay. I'm skipping the order here a bit, but Conce, and I hope Conce, I'm getting your name right. He was one of the first people to ask a question, and he's saying yes to drop off. So I'm gonna, hopefully he's still here to hear this. But can you highlight why Ely Gold is a better investment over Metalla Royalty and the differences in each other's business model? Thank you.
Well, the major business difference in the business model is that we're generating royalties and therefore have a much larger portfolio. And because we're generating our exploration and development royalties through property staking, we're not purchasing those royalties. So where Metalla will go out and spend shareholder monies, equity, to buy longer-term exploration royalties, we focus our shareholder equity purchases, except in some smaller cases like the sleeper royalty, under $500,000. But any large amounts, we focus on royalties that are at or near production. And so that's one very important difference. I think the other thing is that, our focus in Nevada, in Canada, we're not looking at royalties that are just a royalty opportunity that might be any place in the world. And I also think the path to production for our royalties as a whole is maybe clearer. I think we've got better operators and some better assets there. I don't really understand all of their assets, but I know, one of their large ones is a tailings operation in Australia. I don't know how we would ever even evaluate that, whether it was a good investment or not. So I think that probably highlights the major differences, but I think in a lot of ways we're the same. I think if you look at the analysts, our net asset values are similar, done by the outside analysts, and yet we trade at a significant discount to them. So, and I mentioned the other thing that they have really going for them is that New York listing, and that added liquidity and added shareholder base that comes with that.
Okay. We are coming up on an hour here, so I think I'm going to cut the questions off, but we still have a number that we can get to. Um, the next question is from Jacques. Can you provide any more detailed color on current development work by Nevada Gold Mines at Ren, drifting from Banshee?
Well, we really can't, for sure. And there are, but we are putting out a 43-101. We did request a site visit, but because of the COVID restrictions, we weren't able to go in there. Nevada Gold Mines has not, although in their most recent financials they did talk about that. That was some of the development next development work they were doing was on the Ren property. We can't give a lot of other color. The other thing I'd say about the Ren is that we would like to be adding to our position there. So we feel like we're willing to downplay that a bit, and again, we will eventually go out and do a site visit and really be able to report on that. But for the time being, we respect their restrictions, and it being a bigger company, that is one of the negatives, right? You want to have your projects with operators like that, but it's not always the most important thing for them to go putting out all the details of exactly what they're doing month by month. But I think I think you will see a report from them actually probably fairly soon, and that's what we're waiting for. Is a report is for them to tell us what they're doing.
Okay. The next question is from Alfred again. I am assuming, potentially incorrectly, that introducing a dividend means you will be cash flow positive, and so therefore will not be doing any more capital raises. In other words, you will be looking to reinvest royalty streams to grow business and provide a dividend. Is he correct?
Well, look, for a company of our size, I would say no, he's not correct. For us, if we see opportunities, I mean, you can just kind of look. We tend to be more or less conservative, and we use about a 10% of our market cap. So if you say our market cap currently is about 200 million, we will not be afraid to step up and do the right deal and spend $20 million on a royalty deal. Obviously, we don't have the equity or the cash to do a $20 million deal. So the extent that we saw something that big, or saw a couple of $10 million transactions, we'd be eating into our current cash, and then cash flow. If you're talking about a dividend, that's one thing about the dividend is that, that's money you're returning to shareholders and not having for reinvestment into other assets. And it's certainly one of the considerations that we've made thus far, as far as a dividend program, and will in the future, is that if we pay a dividend, that's money we don't have to reinvest into more royalties. So I think you will see us, as we grow this company, have a need for more capital to grow it at the pace that we would like to. I think conservatively. I don't think, you're not going to see us go out and do $100 million transaction. But But if we were to do it 25, and who knows? I mean, if we saw the right transaction, it was $50 million. I mean, then that's something we have to weigh, and that we do weigh in every transaction that we look at. Okay, first of all, is it a good asset, something that fits in our portfolio and that financially makes sense? Then how are we going to pay for it? And if that's going to involve us having to go to the market and raise money, there's certain costs that are associated with that, certain additional risks that are associated with that. And so it's something we factor in. It's if we're able to then use equity to straight away to purchase that. In other words, the seller is willing to take our equity. That makes a transaction a little bit more attractive to us in that we don't have those costs, 15 to 20% costs that you can run in issuing equity through a broker.
Okay, thanks, Trey. The next question, Ursel, talking about net asset value. What is the most widely accepted discount rate for NAV for the smaller and big royalty companies? The multiple on revenue would seem to be much more relevant for the smaller companies.
Well, actually, the multiple of revenue is not really the right number to use, because most of the smaller companies, quite frankly, are revenue deficient, and especially from the royalty. And what you have to, understand for everybody that maybe doesn't know, the revenue multiples and net asset value. Net asset value, that's exactly what it is. It is a model of the future revenues discounted. And so, when you look at net asset value, and you are looking at the current cash flow and revenue, as well as what it looks like over the future. Now, obviously, an asset, if the same asset that isn't going to be producing for 5 years does not have the same net asset value as one that's going to be producing in 2 years, because of the discount. And to answer his question there, the most widely used right now is a 5% discount. That's pretty much the industry standard. And that's on things. That's where you also have to look at what we call that clear path to production. Assets that are riskier in general, and its ability to get into production, either because of the asset itself or the operator that owns that asset, then maybe a higher discount is involved. But the net asset value is the best way to value and compare the junior companies, especially because it is the cash flow model that drives that net asset value. So it gives you that view. It's giving you a view of what the cash flow is going to look like over the next few years.
Okay, good detailed answer there, Trey. And Ursel, I hope that answers your question. John Fisher asked a question about future stock appreciation. I think, Trey, you've already covered that. Someone asked earlier, do you see the stock going to 2? I think that question has kind of been covered. So we'll move to Caden. He's asking, can you talk a bit more on the White Rock deal? And also, does Ely Gold get any upside from the Kirkland deal with Wallbridge? Is 2021 production timeframe for Phenylon realistic, in your opinion?
Well, okay, so I touched on the Phenylon 2021 and why we think it is realistic. Hopefully he heard that answer, and that has to do with them getting the small miners permit and putting together a program so that they can efficiently explore that asset, expand the asset underground, develop the high grade areas that's beneath them, and make a legitimate long-term mill decision about building a mill there. And they can only do that after they really define and come up with a mine plan for on that Tabasco and Cayenne zone. So the other, the White Rock, I'm not sure the question there. White Rock is a project that we just vended out. We just sold, and we are getting option payments on that, and we'll retain a royalty if they exercise the option. But certainly a longer term exploration property for us.
Okay. And there's one question left. Chris Dawson is asking, the Great Western have come on the scene with their Olympic project. How do you see that going?
Well, we haven't gotten any reports from them yet. We really like the Olympic project. It was one where another group had it, and it was with Hochschild Mining. They never really did much work there while they had it for about 2 years, did some mapping and that kind of thing. No drilling on that property did Hochschild do. And then, they kind of bailed out of Nevada, which they tended to kind of come and go. So it's a project we got back and just recently vended it to Great Western. It was a past producing mine, and it's a fairly large play there with a lot of targets. So we're very excited about it. But again, like White Rock, it's one that would fall in our exploration portfolio and be long term. We hope with all these our partners there. We hope them success, and we think they have a very good project. And we did have a very large database on that for them. So I think they have, they've got a good footing. They're good. They're good operators and exploration guys, and I think they'll do well with that project.
Okay. Well, that wraps up the questions. But for anyone, if you have follow-up questions, when this webinar ends, you will be directed to a survey. And one of the survey questions will be, would you like to be contacted as a follow-up from management? So if you answer yes to that, your name will be recorded. We'll have your email. And then that way, Trey and Joanne can reach out to you, and you can have a follow-up discussion if you have any other questions. So thanks again. Just appreciate everyone's attendance, your engagement, always some good questions. Nice to see the global participation we had from UAE to the USA to Europe to Australia, like investors everywhere. So always good to see. So thanks again, Trey and Joanne, for putting this on and taking the time to talk to shareholders, and look for another one in the near future.
Our pleasure.
Great. Thanks, everybody, for tuning in. And like John said, if you do have some follow-up questions, just put them on the survey, and we'll get back to you.
Yeah. And this will have been recorded, so you can look for the recording in the near term, coming soon to a theater near you. So until then, everyone, stay safe, stay well, take care. Cheers.